Hi, everyone. My name is Josh Scott, and I'm a director of conference programming at Pensions and Investments. And I'm extremely excited to be joined today by two fantastic guests covering two different perspectives on fixed income investing. First up, we have Brian Kennedy, who is a portfolio manager for the full discretion team and takes an opportunistic, benchmark agnostic approach to investing. And we have Rick Raczkowski, who is a portfolio manager and co-head of the relative return team, which takes a benchmark aware approach to bond investing that combines a predominantly top-down approach with bottom-up security selection. Brian, Rick, fantastic to have you here today. Thanks for joining us.
Well, thank you for having us.
Thanks. It's good to be here.
Let's go ahead and jump right in. Rick, my first set of questions are for you. The first question, which kind of covers all of the macro data that people have been digesting, in particular inflation. Is it time to stop worrying about inflation and start worrying about economic growth?
We think it's probably too early to say the inflation dragon has been slayed, but inflation is cooling and the Fed is backing off at the inflation fight and is shifting into easing mode. In fact, there's growing concern that the Fed has tightened too much already. The bond market's worried the Fed needs to cut faster and do more than the Fed has forecast. I think the challenge here is that it's hard to know in real time whether the Fed is in fact behind the curve. We know that monetary policy works with long and variable lags, as the saying goes, but it's difficult to pinpoint whether the Fed is being too restrictive. And that's what the market and frankly the Fed are struggling with right now and trying to get right. So for now, we think it's no longer all about inflation. The risks are two-sided. It's about inflation and the economy. And with the economy, it's about the consumer and jobs. The US consumer drives US growth and arguably world growth. And consumer spending is held up pretty well. Consumers are benefiting from steady income gains, positive wealth effects from rising stock and home prices, and some savings left over from the COVID support programs, although that impact has mostly faded in our opinion. Now, we are starting to see some stress in the consumer, especially at the lower end of the income spectrum. That's where credit is expensive and has become less available in some cases. So that's an area of concern. But we think as long as employment holds up, we think consumer spending should continue to be supportive. On the employment front, the employment picture remains healthy, but here too, we are seeing some softening. Job growth is slowing, wages are moderating, the unemployment rate has ticked up. The question is, will an economic slowdown lead to job cuts? We see broadly that companies are losing some pricing power. That's the flip side of lower inflation. But that could mean lower profit margins and the need to reduce labor costs through layoffs. Now, we haven't seen that in a big way yet, but markets are going to be closely watching how this employment consumer spending dynamic plays out. In sum, too early to write off inflation concerns entirely, but the focus has shifted to the growth side of the equation. What does this mean for markets? Well, we think it's a positive for fixed income investors. A market driven by a more balanced inflation and growth outlook, we believe allow bonds to provide their traditional role, not only as a source of income, but as important as an offset and diversifier to investors' equity positions. Now, we saw that play out in early August when bonds really did their job, and we expect that trend to continue.
A fantastic backdrop there. The unique environment that we're in and the unique pricing of assets right now, or just taking in consideration the pricing of assets, a lot of folks are thinking about duration. So how are fixed income allocators approaching duration, and what's your preference on yield curve positioning?
Yeah, we think investors are starting to become more comfortable adding duration. Bond yields, both nominal and real, remain historically high, and that provides a nice cushion to potentially higher interest rates. With the worst of inflation likely behind us, and with growth concerns coming more into focus, bonds can assume their role as a diversifier to investors' equity exposure. So where to invest on the curve? That decision depends on one's expectations for inflation, growth, Fed policy, and perhaps some consideration of future budget deficits. The Treasury curve right now remains relatively flat, so to extend duration means investors are giving up some current yield for potential price appreciation. For those who believe that inflation will remain sticky and the Fed will keep rates higher for longer, staying shorter certainly makes sense. But you do have to keep in mind reinvestment risk if rates come down, especially if you're in the very short end of the curve, such as T-bills. Now, our view is that a soft landing remains the most likely outcome for the market. With growth and inflation moderating, that should allow the Fed to stay on a steady easing path. But we have bumped up our odds of a more significant slowdown, or what we're calling a growth scare. So given that, we're finding the best risk reward in the 5 to 10 year part of the curve. We think that offers a nice balance of good yield, and it should benefit from Fed easing and potential curve steepening. It also provides enough duration to hedge against a potential downturn in the economy without extending too far out to the 30-year part of the curve, which could be affected by concerns over spiraling budget deficits. Although the deficit, we think, is likely a longer-term issue for the bond market. In sum, we think bonds offer good value here, with the best opportunities in the intermediate part of the Treasury curve.
Thanks so much, Rick. A lot of food for thought in those comments alone. But Brian, I want to move to you next and get your sort of perspective with that opportunistic, benchmark agnostic approach. And I'll kick this question to you first. What are the innovative ways that investors can approach diversified credit?
Yeah, as a credit investor, you have a very broad palette to choose from today. 2024 has been a record year for investment grade corporate bond issuance so far. And in addition to that more traditional form of credit exposure, there's also an expanding securitized credit market. Within that sector, we've seen diversifying transactions backed by fiber optic cable, transactions backed by trade receivables, a broadening out of the whole business securitization market, as well as issuance collateralized by data centers. And while the commercial mortgage-backed space has struggled in terms of performance up until very recently, the dispersion within that space has created an opportunity as well. When I think about the levered finance space, the broadly syndicated bank loan market is now larger than the U.S. high yield market, although there are some distinct differences between what the bank loan market looked like 10 years ago versus what it looks like today. And you obviously still have a robust U.S. high yield market as an income generator with what we think are going to be continued lower default rates going forward. Two growing areas that span both investment grade and high yield ratings would be the $1 trillion CLO market, as well as the $1.7 trillion private credit market. So two growing opportunities in that space. And then there's also been growth in the ETF space, which continues to provide investors on the credit side with liquid, passive, and active alternatives. So there's a wide breadth of offerings, and that's just in the US. That doesn't include the diversifying characteristics of EM credit or Europe or Asia. There's a number of different ideas and ways that you can express credit in a portfolio today. And those options that I've mentioned really only cover the cash markets. We think about CDX as a liquid credit instrument in the derivative space as well, on both the investment grade and the high yield side. So there's never been more ways to express opinions or implement portfolio strategy using credit that encompasses thoughts on quality, duration, global preference, or currency as there are today.
Yeah, it sounds like that tool set has really grown for investors. And I wanted to pick on securitized assets in particular. Are you seeing those assets playing a bigger role in overall asset allocation? And if so, why?
Yeah, without question, the expansion of that sector beyond the traditional consumer receivables, such as auto loans and credit card balances as collateral, really brings an additional diversification and opportunity. Securitization in spaces such as solar initiatives, container leasing, and aircraft leasing continue to grow, along with some of the areas I've already mentioned. And again, the CLO market's now $1 trillion in size. So without question, securitized assets are a rapidly growing piece of the fixed income landscape, and they're playing a larger role in our overall asset allocation. One of the advantages we have at Loomis Sayles in this space is the research expertise and the issuer knowledge that enables us to take advantage of what I call a complexity premium. So through thorough analysis, we're able to get comfortable with some of the lower rated tranches in a deal of some of these issuers. That gives us the confidence to buy a single A tranche or a triple B tranche, or in unique situations, even a lower rated tranche that offers a significant pickup in yield over what you'd find in the larger AAA tranches. So this is what I define as a complexity premium. We can do that also in the CLO space as well. So these decisions are not without risk and at times volatility to go down in the capital structure and quality. But in situations where we believe we're getting paid to take the additional vol, we're comfortable with that decision. The performance in the first half of this year in securitized assets would speak to further acceptance and a very strong demand in the securitized space. So as the fixed income market transitions from an era of continually lower interest rates to what we believe is a higher for longer environment on a secular basis, principal preservation and income generation take on an even more important role in a fixed income portfolio. With so many of these securitized structures generating attractive income and returning principal into a higher rate environment with somewhat limited duration in many of these subsectors, their attractiveness for investors continues to grow, and we should see more interest in this space going forward.
Brian, Rick, a really fantastic snapshot of the markets right now. Really appreciate the discussion. It sounds like there's a lot of opportunity out there for investors. Thank you both so much for joining us.
Thanks for having us. I really appreciate it. Look forward to speaking more about this at the conference.
Thank you for having us.
Yeah, it was a really fantastic discussion, and I want to thank everyone for watching. We look forward to catching up with you again soon. Thanks.